So what if you could look at a crypto rally that seems super strong on the surface, but you knew it was actually a house of cards, just waiting to collapse? Well, today we're going to break down a really powerful indicator that does exactly that. It shows you how to see the weakness that's hiding in plain sight.
Okay, let's just start with this quote, because it gets right to the heart of everything. It probably sounds a little weird, right? I mean, why would a trader's favorite signal be something that everyone else sees as strength? Well, as we're about to find out, not all price pumps are created equal, not by a long shot.
So, to make sure we're all on the same page, we're talking about something called a leverage-driven rally. Now, this isn't a price move happening because thousands of people are actually buying and holding an asset for the long haul. No, this is a rally fueled almost entirely by borrowed money. It's pure speculation, just traders betting the price will keep climbing.
And this leads us right into our first big idea, the fragile rally, and why that strength you think you're seeing can be a complete and total illusion.
Think of it like this. A rally that's built on real organic buying is like a skyscraper built on solid bedrock. It's sturdy, it's stable. But a rally that's built on leverage, that's like building that same skyscraper on a foundation of sand. Sure, it might look impressive for a little while, but it's incredibly unstable and just waiting for a reason to fall over.
So how does this shaky structure actually come crashing down? Well, it happens in what's called a cascade. And trust me, it often happens with shocking speed.
The whole process is basically a chain reaction. First, you get the speculators piling in with borrowed money, which creates that artificial pump in the price. But the second that momentum starts to stall, even for a moment, the dominoes start to fall. The most leveraged traders get liquidated, which means their positions are forced to sell. Of course, those sales push the price down even more, which then triggers the next wave of liquidations, and then the next, and the next. It's a really fast, really vicious downward spiral.
Okay, so that's the theory. Sounds pretty convincing, but does it actually hold up in the real world? Let's put it to the test and look at the data behind what we can call the 75% indicator.
And here it is. This is the number that really makes people pay attention. Historically, identifying and trading against these fragile, leverage-driven rallies has worked out about 75% of the time. Now, that's not a crystal ball. It's not going to be right every single time. But what it does give you is a significant statistical edge over time.
But it's so important to have a balanced view here. No indicator is perfect. The strengths are obvious. It's reliable. It exposes these really weak moves, and it helps you find high-probability setups. But you have to look at the weaknesses too. If you're in a truly face-melting bull market, this setup can fail because the trend just steamrolls right over it. It's a powerful tool, not a magic bullet, and it absolutely requires confirmation.
Which, of course, leads to the most important question anyone analyzing a market could ask. This all sounds great in theory, but how do you actually spot one of these fragile rallies while it's happening?
All right, let's get practical. Here is a simple 3-point checklist that traders use with the key signals you need to be watching for.
Okay, here are the 3 things you need to see line up. First, is the upward momentum fading? Is the price starting to struggle to make new highs? Second, you have to watch open interest. Just think of open interest as the total amount of money, the fuel, that's powering all these speculative bets. If you see that number stalling out, or even better, starting to go down, it's a huge sign the rally is running out of gas. And third, and this one is absolutely non-negotiable, you have to identify a clear price level where your entire theory is proven wrong. If you can check all 3 of these boxes, you've got a very, very compelling setup. So after all of that, what's the ultimate takeaway? What's the real edge that a trader gets from this?
And this is really it. The true edge isn't about some secret indicator or a magic formula. It's about a fundamental shift in your perspective. It's the skill of looking at a chart that is screaming strength to everyone else and having the insight to see the hidden fragility underneath it all. It's about spotting when strength is just an illusion.
At the end of the day, this approach really matters for a few simple reasons. First, the concept itself is easy to understand. Second, that checklist gives you a repeatable setup that you can look for over and over again. And maybe most importantly, it's all designed to help you stay on the right side of the probabilities in the long run.
So, we'll leave you with a final thought to chew on. This idea, this concept of apparent strength hiding a fundamental weakness, it doesn't just apply to financial markets. So maybe ask yourself, what other signs of strength in life, maybe in a project you're working on, a business, or even a personal goal, could actually be hiding a fragile foundation? It's a powerful question to think about.